Hello, this is Mike Swanson of Wall Street Window, and I got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website marketviews.tv, and today we're going to talk about Ike's inflows and outflows indicators in regards to the S&P 500 and the XAU. They're indicators that I've followed for years now, and they're often forward leaning indicators. So, how are you doing today, Ike?
I'm doing well, Mike. Thank you for being a guest once again.
Oh, definitely. And, this has been an interesting year defined by extremely low volatility in regards to the stock market and even gold stocks. We kind of talked about that the other week, but I just want to make a point that the Dow just made record on Friday by going over 60 days without moving up or down 1%, and it's never done that before. So we're entering this week with that record having been smashed.
Yeah, it has. And in fact, if there is one theme that I believe everybody would agree on with regards to 2017 is the shrinkage of volatility across all asset classes.
Well, what do your indicators suggest about this? Is this going to continue or change?
Well, Mike, before we talk about our indicators, there are 2 points that I would like to make, which I believe would be helpful for people who listen to us. One is, if you look at oscillators and momentum indicators and all indicators that are based on price, one could say that over the last year haven't worked, and indeed they haven't. The question is why, and that is where I want to shed some light. All of these indicators that are based on price, they're actually some sort of an oscillator. Now, an oscillator is a technical tool that actually is banded between two extreme values.
Like the daily stochastics would be one.
Yeah, or
that's
the weekly,
commonly
or
used.
Whatever.
Yeah, or the RSI, which
Yes.
the RSI is interesting because it made a record high level reading for the Dow at some point last month. So
yeah, exactly. The thing is, as the value of the oscillator approaches the upper extreme value that the author of the formula has written, then the asset is deemed to be overbought or oversold. Okay? The problem with that is that in a very low volatility environment, like the one we have experienced the last 12 months, has to do with the mechanics of these price-based indicators. Now, the purpose of all oscillators is to measure on a percentage scale from 0 to 100 where the closing price is relative to the total price for a specified number of bars in a given bar chart. Okay? What does that mean? Well, I'm going to make it very simple. Let's say that you're looking at a 20-day oscillator, whatever kind of oscillator, momentum, price, okay? Now, if over the last 20 days, the daily movement has been 1/10 of 1%, and today you have a 1% movement, the arithmetic result that you will get will be the same as if over the last 20 days the daily movement was 1% and today's movement was 10%. Okay, you will get the exact same thing. Okay, so visually and arithmetically you get the exact same thing whether you have a 10% movement or a 1% movement. Over the last year, in a very low volatility environment, we're getting oversold and overbought readings in various indicators momentum indicators, price indicators, simply because the price movement is just very little. So if you get, as I said, a 1% movement or a 2% movement, all of a sudden you get an extreme reading. So my point is, in a very low volatility environment, price oscillators, momentum oscillators, price-based indicators simply do not work, because they will give you the same signal whether you have a 1% movement or a 10% movement. Okay? So that's the first point. The second point I want to make is that you and I have been talking for roughly about 17 years. And I have always mentioned this. People follow indicators that are invented by others. Okay? The only person who really knows the limitations of that indicator and the inner workings of the indicator is the person who came up with it. And that is a very important point, because I read all the times interpretations of such and such indicator and such thing. But I have the privilege, the honor to know many of the people who have invented the modern-day technical indicators that we're using. And I know for a fact that their own interpretation of their own indicator is far different than the common interpretation of the very same indicator.
Yeah, that's huge. That's huge. I mean, I know you speak to Sherman McClellan and all sorts of people. You know, it's an important point.
Yeah, well, I can tell you for a fact.
And your own indicators, which we'll get into.
Sherman has a different interpretation of the McClellan oscillator than most people do.
Mm-hmm.
And so does Marvin Appel and Jerry Appel. And I can go on and on. The indicator we're going to talk about is something that I have come up with. So I can tell you with certainty that A is not infallible, but I'm the best person to interpret it.
Okay.
Okay.
Well, it's in some ways, you know, I like to use a combination of indicators, and when most people do that are starting out, they don't really understand exactly what they're doing, and they'll just throw up 10 indicators, but they might be measuring the same thing, like 10 oscillators. That's kind of useless, you know. And the money, you know, what's the actual buying and selling that's going on is is very important, and that's why I really find your indicator very useful.
Okay, well, let's talk a little bit about it before we go to the current readings. Okay, this indicator actually what it measures is the dollar volume of every uptick and downtick for all the 500 stocks in the S&P 500 and also the XAU.
Okay.
And basically, the black line represents the inflows. That is the dollar volume of all the upticks. Okay?
And we're looking at the 25 daily moving average of it.
Exactly.
In the first chart.
Yes. Now, the green line is the line at which inflows and outflows are at equilibrium. That's the 50% line.
So it's almost there basically right now.
Yeah. What does it mean? It simply means that the supply and demand is equal. Like you have maybe 1 billion in sell orders and 1 billion in buy orders at the same price. That's equilibrium. Okay? So if you look at the chart over the last a year and a half, I would distinguish about two things. One is the level, and second is the pattern. The level is at 50%. In other words, right now we are at equilibrium. In itself, in a vacuum, what does it mean? What does it mean? It means it's neutral. The market can go either way. Okay? If you look at the pattern, you go back to what we had earlier in the year, and that was around, let me give you the exact date.
January, isn't it?
27th of January.
Yeah.
The market had been coiling between December and January. The inflows versus outflows have come down to the zero line. That is an important demarcation point. And right there, we saw a resurgence. And the market rallied. It went from 2265 up to about 2400. Roughly a 6% advance. Okay? So let's see where we are right now. If you look at the price pattern in a vacuum, you will see the exact same pattern. Just like back then, price was calling, again it is calling. If you look at the pattern of the indicator, it's also exactly the same. So one would say, oh my God, we're going to have another 5-6% rally.
Yeah, end of the year move or something, yeah.
It could very well be. But because I'm the one who has designed this indicator, there are a few points I would like to make.
Okay.
It's been my experience that usually you have 3 incidents of similar behavior between price and the behavior of this indicator before you get a major top, unless there is an exogenous event that changes things. An exogenous event, it's a low probability event which you can, include in your estimates. Could be some sort of war or terrorist attack. I do not know. You cannot account for that. Okay? So, all else being equal, you have 3 incidents like that. Now, I want to go back to the first incident. What we see right here is that the so-called buying pressure, okay, started to decline around the 9th of December. Now, this indicator has a cumulative effect. I mean, at the end, I add the up and down action on all the 500 stocks, okay? However, it should be noted, and because I've come up with the indicator, I know it, that you could have one stock that trades $1 billion and 5 stocks that trade $200 million each, and when you add up all the numbers, you're going to end up with the same result. Okay? This is important because what I do know, looking at the data line by line, is that between December of last year and January, the reason we had this decline in buying interest had to do with people losing interest in big cap stocks, but the interest was alive and well in the remaining stocks. The current incident has to do with people losing interest in almost 450 out of the 500 stocks that make up the S&P 500. Okay? So, you see the same pattern, but the underlying reason for it is different. Back then, you had a few stocks that had lost buying interest, but the majority had. This time around, the majority of the stocks have lost interest, but a few big mega stocks haven't.
Right.
It's been my experience that you get three incidents like that. In the third incident, which marks the top of a bull market, is that people simply lose interest on all stocks.
Okay.
It seems that we're not there yet. Now, one will say, well, what we're looking at is something that's based on the last 25, or if you look at the next indicator, 50 days. How does that predict what's going to happen in the next 25 or 50 days or a few months? It's been my experience that in the absence of an exogenous event, the tendency continues in the same way, okay? So I would hypothesize, based on my experience with syndicator for over 20 years, that more than likely what we have seen over the last 25, 50 days will continue unless something changes it. And at the moment it hasn't.
Well, that means the continuation then, I would assume, of extremely low market volatility from now to the end of the year. At least. Yeah.
Yeah, and also, even that right now we are at equilibrium, that tells me there's a 50-50% chance that from this point onward, we can have the odds are equal to have a 3 to 5% correction or a 3 to 5% advance. What I do want to point out, though, is that if we do get a 3 to 5% advance, it will be based on buying interest on even a fewer number of stocks. That is the big cap stocks making up the S&P 500. Okay, so if you project this out to the future based on my experience over the last 20 years, then we'll probably have one more incident which will mark the top of the bull market somewhere later next year. But that is based on not having an exogenous event that changes the picture. That is something you cannot predict. It could always happen. Now, if you go back, I apologize, if you go lower to our next chart, this is the very same indicator on a 50-day basis. Now, we can see that it is declining, but it's well above the zero line. That is suggestive that more than likely any decline over the next few weeks will probably be corrective, not something dramatic. And as long as this remains above the equilibrium phase, the equilibrium value at 6%, the bull phase of the market is still alive. So if you put it all together, I would have to say that in the absence of an exogenous event, the market could face a correction, but it still has more to go. The next phase will be much more important to watch with regard to inflows, outflows, for marking an important turning point in the market. And I'm thinking about the S&P 500 and equities, of course. Okay.
Well, in that case, it's a continuation. It seems like there's no, we saw some minor little pullbacks this year in August to the 50-day moving average, something similar in the spring. So it would seem that's all that can be expected again for the time being, if such a pullback even happens.
Well, Mike, my data is telling me that the market is getting narrower and narrower. The question is, how much more narrow can you get before you have a final top?
Yeah.
My interpretation is that it can happen at any time, but more than likely, it still more has time to go.
Right, right.
So anyway,
Well, what?
if you move on,
Okay.
Next important subject is gold. And
Right.
The XAU.
And then with them, they've been, doing nothing basically all year, drifting. And is that gonna, when's that going to change?
Well, I have to say, if you look, the very first index I ever traded was the XAU.
Okay.
I started in this business, buying and selling options of the XAU. And what has attracted me to gold and gold stocks over the years is not some ideology, but it's the volatility.
Right.
They simply move a lot.
Right.
So if you look for something that moves a lot, you look at gold stocks. The last 12 months, the volatility in gold, and more importantly in gold stocks, has shrunk by 2/3. That is really extreme. You can go back 40, 50 years and you will not find such a low volatility in gold stocks. My point is, and my belief as a matter of fact, that this is not going to last forever because it is completely out of historical norms.
Right.
Could it last a little longer? Yes. But it's not going to last forever. If you look at the inflows, outflows on a 25-day basis, what you see here is that the outflows are exceeding inflows. That tells me that gold stocks have not turned the corner yet. But on the other hand, they don't have that much to go on the downside either.
We saw these indicators spike up, I think in June or July there on the chart. It's something.
Yeah.
It seems like the same thing repeating again.
Exactly. And if you look at the price, it's not at those levels, and very near those levels.
Yeah.
And if you look at the same indicator on a longer term basis, the 50-day moving average, you will see that there isn't much distance between the outflows, inflows, and the 50% equilibrium. So that tells me that in the short term, gold stocks could have some additional pressure, but longer term, meaning 4, 5, 8 weeks from now, in the absence of an exogenous event, which is something that, as I said, cannot be predicted, we should see higher prices. So if you put it all together, the fact that we have had now 8 weeks of downside action, yet outflows have not exceeded 55%, when the equilibrium level is just 50. That tells me the downside risk is probably limited to about 6, maybe 8%.
Well, it seems like in the past couple years, there has been slight dips. Well, there has been dips of different magnitude in the last couple years going into the middle of December, it seems. And then it tends to rally after that. And I know we got that Fed meeting in the middle of December coming up where they're supposed to raise rates again. So maybe that could be, something for people to sell into and then buy sell the rumor, buy the news, so to speak.
Yeah, it could very well be that we'll get another really important bottom in late November or sometime in December. As I said, in the absence of an exogenous event, my inflows, outflows analysis says that there is going to be additional pressure, but that pressure will be limited. If something changes, then we'll have another interview and I will point it out. As it stands right now, that's my story and I'm sticking to it.
Yeah, well, it seems like more of the same of what we've been experiencing all year, but at some point that's going to change, and it could be changing when these indicators turn around to become more bullish, you know.
Yeah.
And that would it's got, you know, big ramifications for next year. What happens next year with gold?
Yeah, I agree.
So it's you know, in some ways I feel like falling asleep, you know, on the markets in November, but what these indicators do could really set the stage for some excitement in 2018.
I definitely agree.
Well, I did take quite a bit of time here talking to me and everyone else, so thanks for taking the time to do this interview, and we'll do follow-up interviews as time goes on.
Thank you, Mike. Have a great week.
Yeah, thank you.